Welcome, everyone. Today we are going to explore one of the most powerful tools that every trader needs to understand. It is called the volume indicator. If you have ever looked at it and felt lost or unsure, you are not alone. By the end of our time today, you will have a clear understanding of what a volume indicator is, why it is so important, and exactly how you can use it to improve your trading. Imagine you had a way to see the heartbeat of the market, a tool that reveals whether a price movement has true strength or if it is just a mirage. That is exactly what the volume indicator does. Let us jump right in. So, what exactly is a volume indicator? It is simply a tool that shows how many shares or contracts have been traded over a specific time period. Usually, you will see it as bars at the bottom of a price chart. When you see these bars, you are seeing the market's activity. High bars mean a lot of trading has happened, and shorter bars mean there has been less trading. This is important because it tells us how strong or weak a price movement really is. If there is a big price change, we need to know if a lot of people were involved. High volume means yes, and that could mean the trend will likely continue. If there is low volume, it means not many traders were active, and the price movement might not last. Can you see why this is so important? Another key aspect to consider when analyzing volume is understanding common chart patterns. Volume is a great tool to confirm classic chart patterns like head and shoulders, double tops, double bottoms, triangles, and flags. When you see a head and shoulders pattern, for instance, volume can help confirm the strength of the neckline break. If the volume is high when the price breaks below the neckline, it suggests that the downtrend is likely to continue, confirming the reversal. Similarly, in double top and double bottom patterns, increased volume during the breakout indicates strong conviction in the new trend direction. In triangle patterns, whether ascending, descending, or symmetrical, volume plays a big role in confirming the breakout. For example, in an ascending triangle, the price gradually makes higher lows while facing a resistance level. If the volume increases as the price breaks above the resistance level, this is a strong sign that the breakout is real and the uptrend will continue. On the other hand, if the volume is weak, it might indicate that the price will fall back into the triangle pattern. Flags and pennants are also common patterns where volume is key. When the price breaks out of the flag or pennant, strong volume is needed to confirm the continuation of the trend. Paying close attention to these patterns and watching the volume can help you decide whether the price action is reliable or if it might fail. Each chart pattern tells a story about market behavior, and volume adds an important layer of context to that story. For example, in a head and shoulders pattern, high volume at the breakout confirms that many traders are convinced about the reversal, increasing the likelihood of success. In double top and double bottom patterns, a breakout with increased volume suggests strong conviction and reliability in the new direction of the trend. Let us take a closer look at triangles. Triangles are continuation or reversal patterns, depending on their context, and include ascending, descending, and symmetrical triangles. In an ascending triangle, where the price makes higher lows while facing resistance, a breakout above the resistance with strong volume confirms that buyers are in control and that the uptrend is likely to continue. In descending triangles, where lower highs are formed while holding a support level, a break below the support with high volume signals that sellers have taken control and a downtrend will likely continue. In a symmetrical triangle, the price moves into a narrowing range with both lower highs and higher lows. When a breakout occurs, strong volume is crucial to confirm the direction of the breakout, whether up or down. Wedges are another type of pattern where volume plays a significant role. Rising wedges are bearish patterns that occur in uptrends, and falling wedges are bullish patterns found in downtrends. Volume should decrease as the wedge forms, indicating a loss of momentum. When the price eventually breaks out of the wedge, an increase in volume validates the move and confirms that the market has chosen a direction. Now, let us explore flags and pennants, which are continuation patterns that often appear after a sharp price movement. In a bullish flag, the price rises steeply, then moves sideways or slightly downward in a rectangular pattern. A breakout from the flag with increased volume indicates that the buyers are still in control and that the uptrend is likely to continue. In pennants, the price consolidates in a small symmetrical triangle after a sharp move, and a breakout with high volume confirms that the previous trend is set to resume. The cup and handle pattern is a bullish continuation pattern that resembles the shape of a teacup. The cup forms as the price gradually bottoms out and rises again, while the handle forms as the price consolidates. When the price breaks out above the resistance formed by the handle, strong volume confirms that buyers are confident, signaling a continuation of the uptrend. By mastering how volume behaves with different chart patterns, whether head and shoulders, double tops and bottoms, triangles, wedges, flags, or cup and handles, you can significantly increase the accuracy of your trades and feel more confident about your entries and exits. Additionally, volume helps confirm whether a breakout is genuine or false, giving you a better understanding of the market's intentions. Do you see how these patterns and volume work together to provide a clearer picture of the market and improve your trading decisions? Every time you look at those volume bars, they are giving you a story. If a bar is very tall, it means many shares were traded in that time period. A smaller bar means fewer shares. It is as simple as that. Some trading platforms also use colors. Green bars might mean buying volume, while red bars mean selling volume. If you have ever noticed these colors, they can help you tell if buying or selling pressure is stronger. Next time you are looking at a chart, look at those colors and see if you can spot which direction traders are pushing the market. It is almost like being able to see the mood of the market in real time. Let us talk about the relationship between price and volume. When a stock price is rising and the volume is also high, that is a good sign. It means that buyers are really interested and are backing up the price increase with a lot of activity. But if the price is rising and the volume is low, that might be a warning. It could mean that only a small group of people are buying and that the price might not stay up for long. This is often seen as a weak rally, and the lack of volume suggests a lack of broader market participation. Let us take a deeper look at specific chart patterns and how volume can confirm or invalidate them. In an uptrend, if the volume is increasing as the price moves higher, this is a confirmation that the trend is strong. However, if the volume starts to decline while the price is still rising, it might indicate that the trend is losing momentum and a pullback or reversal could be imminent. This is especially important when identifying exhaustion moves, where prices continue to rise but volume starts to taper off. Similarly, if the price is dropping and the volume is high, it means there is strong selling pressure and the downtrend could continue. This high volume signifies that many traders are actively participating in the sell-off, making the downtrend more reliable. On the other hand, if the price is falling but the volume is light, the market might not be that committed to the downtrend, and a reversal could happen soon. This could be a sign that sellers are not fully committed, and buyers might step in to push the price higher. Volume divergence is another critical concept. Divergence occurs when the price and volume do not align as expected. For instance, if the price is making higher highs but the volume is decreasing, it could signal a potential reversal. This divergence between price and volume suggests that the strength of the trend is weakening as fewer traders are supporting the price move. Conversely, if the price is making lower lows, but the volume is also decreasing, it could indicate that the sellers are losing steam, and a reversal to the upside might be coming soon. Have you ever felt a bit unsure about a stock when it was climbing? If the volume was low, that is probably why. Low volume during a rally is a red flag that the move might not be sustainable. Similarly, when examining downtrends, the volume provides insight into the conviction behind the move. High volume during a downtrend indicates strong selling interest, while low volume suggests that the market might not fully support the downward movement, potentially setting the stage for a bounce or reversal. Let us expand on how volume interacts with different chart patterns. When we see classic patterns like head and shoulders, double tops, double bottoms, triangles, and flags, volume is crucial for confirming the strength of these patterns. For instance, in a head and shoulders pattern, the volume should increase as the price breaks through the neckline. This increase in volume shows that there is real conviction behind the move, indicating that a reversal is likely to continue. In the case of double tops and double bottoms, these are patterns that signal potential reversals. The key is to watch for increased volume during the breakout from these formations. If the price is breaking out of a double top and the volume is high, it signals that sellers are taking control and the price is likely to move downward with strength. Conversely, in a double bottom, high volume during the breakout to the upside confirms strong buying interest and the start of a new uptrend. Another important pattern to understand is the triangle. In ascending triangles, the price makes higher lows while facing a resistance level. When the price eventually breaks above the resistance, high volume is needed to confirm that the breakout is valid and that the uptrend will continue. In descending triangles, where lower highs are formed while holding a support level, a break below the support with high volume signals that the sellers are taking control. In symmetrical triangles, where the price forms a series of lower highs and higher lows, volume plays a key role in confirming the direction of the breakout. Strong volume during the breakout means the market is committed to the move, while weak volume may indicate a false breakout. Flags and pennants are continuation patterns that also require volume confirmation. When the price breaks out of a flag or pennant, an increase in volume confirms that the trend is likely to continue in the direction of the breakout. For instance, if the price has been rising and forms a flag, a breakout above the flag with strong volume indicates that buyers are still in control and the uptrend is likely to continue. If volume is lacking, the breakout might fail and the price could fall back into consolidation. Wedges are another pattern where volume is essential. In both rising and falling wedges, volume should decrease as the pattern forms, indicating that the momentum is slowing down. When the price finally breaks out of the wedge, the direction of the breakout should be confirmed by an increase in volume. This helps to validate the move and ensures that the breakout is not just a temporary spike. Cup and handle is a bullish continuation pattern that also benefits from volume analysis. As the price forms the cup, you often see volume decreasing during the consolidation phase. When the price moves to form the handle and eventually breaks out above the resistance, A strong increase in volume confirms the validity of the breakout and signals a continuation of the uptrend. These patterns are all strengthened by volume, which serves as the confirmation tool that gives us more confidence in the price action. By observing volume during these key moments, traders can make more informed decisions about whether a pattern is likely to succeed or fail. Understanding the role of volume in these chart patterns can significantly improve your trading strategy and help you navigate the market more effectively. The next time you see one of these patterns forming, make sure to check the volume closely, as it could be the deciding factor in whether you enter or avoid the trade. You might wonder how we can use the volume indicator to spot trends. One of the best ways is to use it to confirm trends that are already happening. For example, in an uptrend, you want to see rising prices along with increasing volume. This means the buyers are active and interested. In a downtrend, if the price is falling with high volume, it confirms that the sellers are in control. But what if the price is going up, but the volume is not? This could be a warning sign that the trend might be losing strength. Have you ever had a feeling that a trend was going to change, but could not quite put your finger on why? Volume can be the clue that helps you see what is coming. Now let us discuss breakouts and why volume is so important when they happen. A breakout is when the price moves beyond a key level, like an important support or resistance. But just because a price breaks out does not mean it will keep going. Volume is what can help confirm if the breakout is real or if it is just a false alarm. For example, if a stock breaks above a resistance level and the volume is high, that is a good sign that the breakout is strong. But if the volume is low during the breakout, it could mean that the price might not hold. This is what we call a false breakout. A false breakout occurs when the price briefly moves beyond a key level, but does not have the strength to maintain the move, often resulting in the price reversing and moving back into the previous range. High volume during a breakout confirms that a large number of participants are supporting the move, increasing the likelihood that the breakout will be sustained. There are different types of breakouts to be aware of, such as continuation breakouts and reversal breakouts. Continuation breakouts occur in the direction of the prevailing trend and are often accompanied by strong volume. This type of breakout signals that the trend is gaining momentum. For example, if a stock has been in an uptrend and breaks above a resistance level with high volume, it indicates that buyers are still active and the uptrend is likely to continue. Reversal breakouts, on the other hand, occur when the price moves against the prevailing trend. In this scenario, the breakout must be supported by strong volume to confirm that the trend reversal is genuine. If the volume is weak, the breakout may fail, and the price could revert to its previous trend direction. Another pattern to consider when analyzing breakouts is the retest. After a breakout, the price often comes back to test the broken support or resistance level. This retest can provide another opportunity to enter the trade, especially if the retest is accompanied by increased volume. For example, if the price breaks above resistance, then comes back to retest that level with volume picking up again, it indicates that the new support level is being defended by buyers and the uptrend is likely to continue. Think about the last time you saw a stock make a big move. Did you check the volume? Watching volume during breakouts and retests is a habit that can make all the difference in your trading decisions. By paying attention to volume, you can distinguish between real and false breakouts, allowing you to make more informed trading choices and avoid potential traps. Volume spikes can also tell us a lot. A volume spike means that there is suddenly a lot of trading happening compared to before. This can happen when there is a major price change. When you see this, it can be a sign that a new trend is starting. For instance, if a stock has been climbing steadily, but suddenly there is a big red volume bar and the price drops, it might mean that things are about to change direction. Have you ever seen a spike in volume and wondered what it meant? Paying attention to those spikes can help you catch reversals before they happen. Another great way to use the volume indicator is to combine it with other tools. Pairing volume with moving averages is a good example. Moving averages help us see the general direction of a stock. If the price moves above a moving average and the volume is high, it shows the breakout has strength. You can also use tools like the relative strength index, which can show if a stock is overbought or oversold. If the relative strength index says a stock is overbought, but the volume is still increasing, the uptrend might still have some room to go. It is like having more than one piece of the puzzle to put together. What other indicators do you use when looking at volume? Volume is also very useful when it comes to support and resistance. These are key levels that traders watch closely. Support is where the price tends to stop falling and may start to rise, while resistance is where the price tends to stop rising and may start to fall. When the price is getting close to a support or resistance level, it is very important to look at the volume. If the volume is high as the price gets near one of these levels, it could mean that a big move is coming. For instance, if the price is approaching a support level and the volume is increasing, it may indicate that buyers are stepping in strongly, which could lead to a bounce off that support. On the other hand, if the price is near resistance and the volume is high, it could suggest that there is enough buying interest to push the price through the resistance level, leading to a breakout. Breakouts are more significant when they are accompanied by strong volume because it shows that there is real conviction behind the move. If the price reaches resistance and the volume is rising, a breakout could be on the way. High volume in this scenario means that many traders are involved, adding strength to the breakout. Conversely, if the price approaches a resistance level and the volume is low, it may indicate that the breakout attempt is weak and could fail, causing the price to fall back. This concept also applies to support levels. High volume at a support level means buyers are actively defending that level, making it more likely for the price to bounce. Volume can also help identify false breakouts. A false breakout occurs when the price moves beyond a support or resistance level but lacks the volume to sustain the move. In these cases, the price often reverses and returns to its previous range. For example, if the price breaks above resistance with weak volume, it may quickly fall back below the resistance, trapping traders who expected a strong breakout. By watching volume closely, you can avoid getting caught in false breakouts and make more informed trading decisions. Have you ever seen a stock struggle at a resistance level, then suddenly shoot up with a surge in volume? This is often a sign that a significant breakout is happening and that the market sentiment is strong enough to push the price higher. Next time, take a look at the volume and see if it was part of the reason. Understanding the interplay between volume and these key levels can help you gauge whether a move is likely to succeed or fail, allowing you to make smarter trading decisions. There are some common mistakes people make when using the volume indicator. One of the biggest is ignoring the price. Volume is helpful, but you always need to look at it in relation to what the price is doing. If you focus only on volume, you are missing half the story. Another mistake is to overreact to sudden spikes in volume. Not every spike is important. Instead of reacting to every change, try to focus on the bigger trends in volume. This will help you make better decisions and avoid unnecessary stress. Can you think of a time when you might have jumped too quickly because of one big volume spike? Staying calm and looking at the bigger picture can really help. Market conditions can also change how volume behaves. In a trending market, volume will usually follow the price. So if prices are going up, you want to see volume going up too. This indicates that buyers are actively participating and supporting the uptrend. If prices are falling, you should see volume rising to confirm that sellers are in control. High volume during a downtrend shows that there is strong selling pressure, which makes the downtrend more reliable. However, in a market that is moving sideways, where the price remains in a range without a clear uptrend or downtrend, volume tends to be lower. In these cases, it is common for the volume to stay muted until a catalyst drives price movement. When you see a sudden spike in volume during a sideways market, it often signals that a breakout is about to happen. For example, if the price has been trading in a narrow range for a while, and you suddenly see a surge in volume along with a strong price movement, this could indicate that the market is ready to move in a new direction, either up or down. The volume spike provides the energy needed to push the price out of the range. There are also specific volume behaviors to watch for during different market conditions. In trending markets, if the trend is strong, volume will usually rise as the trend continues. For example, in an uptrend, volume should be increasing on the upward moves and decreasing on pullbacks. This behavior suggests that buying interest is still present and that the pullbacks are just temporary corrections. In a downtrend, volume should increase on downward moves and decrease during upward corrections, indicating that the selling pressure is strong and the corrections are weak. In a sideways market, volume can help you identify accumulation or distribution phases. Accumulation occurs when buyers are gradually purchasing shares, often seen with steady but not dramatic increases in volume at lower price levels. Distribution, on the other hand, happens when sellers are slowly offloading shares, usually with increasing volume at higher price levels. When the price finally breaks out of the range, the direction of the breakout can often be confirmed by looking at the volume patterns during the range-bound period. It is interesting to see how volume acts differently depending on the market, is it not? Volume tells us a lot about trader commitment and market sentiment. Think about how these different volume behaviors have played a role in your past trades. Whether you are trading in a trending market or a range-bound market, understanding how volume behaves can give you an edge in anticipating the next big move. Let us wrap up by pulling all of this together. The volume indicator is one of the most powerful tools you can use to understand what is really happening in the market. It helps you confirm trends, spot strong breakouts, and get a sense of the market's overall sentiment. Start adding the volume indicator to your charts and see how it can help you make better trading decisions. Combine it with other tools for a more complete view. Do not worry if it takes a bit of time to master. With practice, you will find that volume can be one of the best guides in your trading journey. Thank you for joining me today. Keep exploring, keep practicing, and remember to watch that volume closely. It could be the key that unlocks your next big trading success.